In this video, I'm going to talk through some trades I received from another trader and how I would improve my trading strategy. We can see here we've got thin liquidity before the open, and so it's 8 o'clock European time. So it looks like this is the open. So there's two things I want to point out here. One is the trader has signaled a wedge top pattern. We don't have a moving average, but I'm sure it's just sitting above the moving average. And then we have this huge bar on the chart here. So the first comment I would make is, if you're trying to improve your trading, I would ignore large bars. I found that I was not able to trade them well. And when I did, I would end up taking much larger than average losses. And by removing them from my trading, I actually found it to be much more peaceful. So I would look at how many of your trades involve the biggest bars on the chart. Okay, so that's step one. Step two is, if that's 8 o'clock European time, that's probably market open. So the next step I would look at is how many of your trades are in bars 1 to 3. These are typically the biggest bars on the chart in terms of volatility. And if you think about it, there's a lot of out of session price action and orders, and they all start to get filled in these first 3 bars. We know at the open of every day, 50% of these first moves fail. Okay, it's the wrong way. So if you wanted to build a reliable trading strategy, you would actually be doing the opposite. You would actually be fading these opening moves. And that's very, very difficult to do. That's not something I'm very good at, even though I know mathematically that's the right thing to do. So I would look at first, how many of the trades are big bars, cut them from your trading, at least go back and look at how many times those trades are there and how well you trade them. Secondly, how many of your trades are in the first 3 bars? So that's my first 2 comments. Secondly, I can see by where the trader has put their order, okay, 1 tick below the low of this big bear bar. What they're saying is, I think it's a bear breakout and I want to use the most aggressive order entry I can, which is a stop entry. But what's the problem with that order? Well, the location. If this is a wedge, this is a bull trend, this trend gets broken, and we know the next phase of the market cycle is what? It's a trading range. So in order to take that sell, what you're actually doing is selling at the bottom of a trading range. So taking that bet is betting that there's a 60% chance we're going to get a measured move down. And you can see in 1, 2, 3 bars, all the institutions were doing the exact opposite. They were buying from you. They know that there's a very high chance wherever we broke out of this trend, we're going to come back and test that point. So can you see where we broke below these lows? That's where traders were selling, and they were selling for a scalp. So that's point 3, is look at the market cycle. If it's a wedge top, the next phase of the market cycle, if that either gets a bull breakout and follow through, measured move up, or this collapses into a trading range, in which case I want to be a buyer at the lows and not a seller. So first suggestion was looking at big bars. Second suggestion was how many of your trades are in the first 3 bars. And the third suggestion was looking at market cycle. Okay, so there's 3 things you can look at your trading already. Fourth suggestion, let's looking at trade management. This trader sold and they wanted a big bear bar closing on its low. Did they get that? No, they got a bull doji. And that means more traders at that point thought the exact opposite. They were buying there and bears were buying back shorts. You wait for 1 bar, that's your entry bar. Okay, so signal bar, big bear bar, entry bar, bull doji. So already something's wrong with the trade. And then follow through bar, closing at the low of that prior bar. This is a warning that these traders are not that bearish. If I had sold with a big risk and my trade is not working within 1 or 2 bars, then there's a good chance I'm doing the exact opposite of what I need to be doing. And when you see this bar, which closes back in the range, this is your signal that says I might be selling at the low of something. So okay to exit here, that's fine. Okay to have a stop up here, but you can see from this point, 3 consecutive opposite bars, the trade was already failing earlier. So what I would look at is, how many of your trades work within 1 bar, 3 bars, 5 bars, 7 bars? This very aggressive breakout entry with high momentum should immediately take off. So if you take a high momentum trade and it doesn't work immediately, then you're not looking at a high momentum trade. More likely you're in a trading range. So that would be 0.4. Let's look at order entry again, 0.5. This is a bull trend. Higher high, higher low, higher high, lower low. So at this point, the bull trend has actually failed. Then we get a new high, higher low, higher high. Here is a bull trend. The point it fails is here. What I'm going to do is I'm going to get rid of those lines and I'm going to put this back. This is the last leg of the bull trend. I'm pretty sure without measuring it with a fib, traders who sold below that swing point already made 2R. So they took a low probability trade and they already got the reward they needed. And where you're entering is where those traders who are already in before you are getting out. And this is a really common area. And this is something I've worked on a lot in my own trading. When I get in, I need to look at who is already in the market and where are their profit targets. Because if I think about this logically, if I sell here, on the next bar, I want more bears to think, oh no, I should have sold earlier. And then on the next bar, oh no, I should have sold earlier. I want them to chase and chase and chase the market down so that I can exit with a profit. But if I sell at this price here and traders have 5, 10, 15 minutes to do exactly the same thing I did, how urgent's the market? There's zero urgency. And that means people are happy with the price. And that's a problem because I've taken a big risk to be in the market here. So that would be 0.5. When I look at my trades, how easy is it for everyone else to get the same order I did? Let's look over here a little bit later. Where you got out of your trade, where you finally gave up on that short, there's a reason you finally gave up. And that's because you got this huge breakout bar. And you thought, oh no, I don't want to be short. Notice how difficult it was for bulls to get that price. We only touched it once there. Imagine you tried to buy the top of that bar and you thought, no, I'll wait. If you put an order there, it missed. If you put an order there, it missed. If you put an order here, it missed. This is urgency. So what you wanted to happen here didn't. And when you got out, it did. And so some traders will actually reverse there. They suddenly realize urgency is in the opposite direction and they need to be doing the exact opposite of the trade they just took. So on that one chart, there are 1, 2, 3, 4, 5 areas I would be using to analyze my other trades. So thanks for sending that in. Let's have a look at the next chart. Okay, in this chart, so this is the follow-on trade from there. You got out of your short there. That's where you go in, and then you reversed. So some traders won't buy that outside bar. They'll wait for consecutive bull bars and they get long there and their target's up there. So you got in actually earlier than they did. And that means you've got lower probability, which means you have more risk reward. Okay, if I get in before you suddenly have a high probability trade. I must have taken a lower probability trade. That means my reward's going to be higher. You got more information, therefore your target's going to be closer. So you got in there and you quickly took your 1R. And that's okay. One thing you can look at here is when you took your exit, you're actually getting out with a breakout and follow through. So this is the signal that we're going higher. And you got out the moment that signal was there. So my advice would be on the second chart, look at your exits and how often is your exit an opposite signal, okay, a signal to get short, and how often is it actually another buy signal? And there are professional traders who instead of getting out will actually increase their position. These are the kind of trades that pay for all the mistakes. This bar here didn't work, because you took that trade. You finally got out here because it was too bullish. You got consecutive bull bars. Now you got to break out and follow through. This trade is getting bigger. Where will they get out? Probably get out below a bear bar, somewhere up here, or wherever their 2R target was. So up there. So on this chart, I would be looking at exits. So good trade. How could you hold for a bigger profit? Look at waiting for your exit bar to print. Awesome. Thanks for sending in that chart. Let's have a look at chart 3. So here, very strong bull spike, very steep. But also when we look at each of these bars, we're overlapping. So this is the third trade of the day. So you took a loss. So you ended short there, took a loss there. You switched to long there and got out there. Here is a breakout And here we're closing back in this range. Stop above the high, sell, and there's your target. Now, this was a good trade. I think this has a good chance of being a trading range, okay, particularly when this high one failed. Okay, so look at it this way. Breakout to a new high, pull back, okay, because that's the breakout point. And then that buy signal failed. No one wanted to buy outside this range. And so you front run the sell there all the way back to the lows of this range. Good trade. The bit I don't agree with is this comment. So good to take profits at 1R. That's okay. Good to take profits before the bottom. He said, I don't want to make the same mistake as the first trade. This trade is totally different from this one. This is a reversal trade. This was a continuation trade. So here you thought this was a new breakout and you were selling for it. That didn't work. Here the bulls have a breakout and it's failing. So this is a reversal trade. So the exercise I would look at is, and I still use this exercise. This is one of my favorite exercises I'm going to talk about in Orlando in a couple of weeks. I look at all trades as of only being two kinds. One's a continuation, one's a reversal. So continuation means the market is doing something and I'm expecting it to do something in the same way. This is going down. I'm selling for it to do that again. Okay. A reversal is the market was doing something and I'm betting that it's not going to do that anymore. It's going to do the exact opposite. Now, in general, when you take a continuation trade, you're looking for about 1R. Okay. Because it has higher probability. In general, when you take a reversal trade, you're actually looking for 2R because they are lower probability. So I wouldn't compare those two trades. What you're actually doing is using a loss from earlier in the day and you're shortening the target on a later trade. But I would look at them as different, if that helps. I think that's really useful that you send in 3 charts. So I'll recap my advice from the 3 charts. In this chart, my suggestion was 1, biggest bar on the chart, totally ignore it. Ignore all trades that come off it. 2, look at how many of my trades occur in the first 3 bars, even the first 6 bars. What would happen if I did not take any trades in those first 3 bars? When I first did this exercise, that immediately got me to break even. That's how powerful it is. Thirdly, look at the market cycle and do some work on it. This is a wedge top. Wedge top means I'm in a bull channel. Okay, if we suddenly get a bear breakout, that doesn't mean a bear trend. That means a trading range. So look at the market cycle of your trades. 4, if I take a high momentum trade, my expectation is high momentum. If I get anything other than high momentum, then I'm in the wrong trade. So tip 4 was look at momentum. How many really strong sell signals, took a sell here, immediately got good entry bar and follow through. This is a high momentum trade. This was not. And then 5, if I take a sell, I need to make sure that the traders who are short before me are not at their profit targets already. I want there to be urgency. And if I take a sell, I want to make sure that anyone who missed it has to chase. But instead, we spent 4 bars of that same price. So that was the first chart. Second chart, switching to long, that's fine. Consecutive bull bars, that's okay. We're continuing, you've got a trend line there. We're continuing up. Your exit, you've got a bull bar, and then here's your breakout and follow through. So if you got out there, this is actually another buy signal. That's why there's a small gap there. Traders saw that and computers instantly hit buy because it's a breakout and follow through. So my advice there was to look at your exits and see whether my exit is an opposite signal or not, and see if that helps. And then on chart 3, here you're getting the reversal down. This is a reversal trade. So this was a continuation trade. This is a reversal trade. We're in a very tight bull channel. You're taking a reversal trade. Generally, when you take a reversal trade, you're looking for more than 1 times your risk to make up for the lower probability. So continuation, looking for 1R. Reversal, looking for more than that. Well, I hope you found that valuable. There are 7 tips I would use to look at my trade markups and see how they apply to my other trades. Great thing about trading is we probably have about 5 to 7, sometimes 10 repeated mistakes, and fixing any one of those is going to make a real difference to your performance. Thanks for sending it in, and I'll catch you in the next video.